Ladies and gentlemen.
Welcome to the BlockCrunch podcast, the go-to podcast for investors and builders in crypto.
This episode of the BlockCrunch podcast is brought to you by CoinFlex and Paraswap. Stick around to learn more.
Hey everybody, welcome back to another episode of the BlockCrunch podcast. And apologies if you hear seagulls in the background because I'm here in sunny Thailand, just trying to stay out of COVID in cities. But I'm really excited to have my friend Dmitry from 1KX on the show today to talk about a wide variety of topics, all the way from bridges to the recent bridge hacks to his investments through 1KX into DAOs and other projects as well. So Dmitry, welcome to the show.
Thank you, Jason. Good to see you.
Yeah, it's been a long time coming. I've wanted to bring you on the show for a long time, especially for your blog posts on bridges. That's something that I always refer back to every time we talk to a new bridge project. But for those who are not familiar with you yet, can you tell us a little bit about your journey into crypto, how you got involved with 1KX, and what is 1KX?
Yeah, totally. I guess my journey started in traditional finance. Spent 6 years working for a bank. The first 4 were doing a variety of strategy roles, often building out, internal fintech products around real-time payments and big data analytics. And around 2015, saw the writing on the wall that fintech was eating finance. And so at the time wanted to help the bank compete. So spent my last 2 years there building out their innovation labs, which was more on frontier tech, particularly machine learning, but we also did in early blockchain proof of concept in 2016. And there were still issues with it, like things around, regulatory clarity and developer tooling. But it did make me realize that, DeFi was eating fintech. And so I kind of jumped into crypto, worked on a startup for a year. It was like similar to CoinTracker, portfolio manager, robo-advisor. Ended up sunsetting that and got introduced to a fund out of New York called Coin Fund. I spent a year there doing research and due diligence, and then got connected with a family office called Bollinger Investment Group, and then spent 2 years there, leading investments and research. Did around 25 deals. And we had actually like a lot of overlapping portfolio companies with 1KX. So I'd known the team for quite a while. Just really love how diverse everyone's backgrounds and worldviews are. So I've actually been on the team for exactly a year now. So it's been a fun ride. And the fund itself, early stage token fund that's really focused on bootstrapping token networks. So very much token maximalists, DAO maximalists. I tend to be more contrarian in some of our thinking. But I think the space itself has shown to violate a lot of narratives. So I think we're performance is showing that sometimes it's good to be on the other side of bets.
Definitely. And we had Lassie, the co-founder of 1KX on the show, I think maybe 2 years ago now. And I remember distinctly he was saying that he was a token maximalist. I think that was like around the time when everybody was like, hey, maybe tokens are not going to work out. Maybe we should do like equity only and companies only. So that obviously, paid off massively. And I'm super excited for what you guys ended up doing as well. And I guess one thing that I really wanted to kind of kickstart our conversation with is bridges, because in the past, I'd say 2-3 months alone, we had I think $320 million hack for WormHole. And then we had the $600 million exploit for the Ronin Bridge for Axie Infinity. So this is not chump change. This is a lot of money, even for, crypto's crazy world. And you wrote one of the best blog posts about bridges that I've ever read. So I constantly come back to it. So can you maybe first help us understand, first of all, why are there so many different bridges? Are there different types of trade-offs, and, what are the different types out there?
Yeah, for sure. I mean, it's sad that there have been so many issues with it, but it's really difficult tech to build. I think there are a lot of trade-offs. I mean, like there are a lot of different flavors of these bridges, which is why like there are so many trade-offs. And then you could cut it in different ways. I mean, like the way at a high level, I think about a bridge as some piece of technology that like passes different messages between two different chains, two different domains. It's a problem rooted in distributed systems, and there's different ways you could produce, I guess, like a product out of this. It could be like an asset specific bridge, like wrap Bitcoin. It could be a chain specific bridge like Ronin. It could be application specific that just focuses on swapping like Thorchain, or it could be more of like a generalized a message passing bridge like Nomad that could do other things outside of just transfer assets. And I think that there are other kinds of use cases here. And I think like those trade-offs is around like what's your security model? What's your economic throughput? What's your asset availability? Which chains are you connecting to? What are the kinds of things you could be doing on these bridges? Is it just transferring assets, or is it more like generalized state? So yeah, I think like there's a ton of different trade-offs that I think you can make, and these things are just really tough to build. And I think like with the hacks, we've seen from like simple bugs, like the wormhole hack, which was not really a security model issue. It was really just like an unfortunate bug that was not caught, to things like Ronin, which is like quite interesting because that was actually a vulnerability in the root of trust in the actual security model. So there's a lot of ways that things could go wrong. That is like both like theoretical and like implementation focused.
And what do you foresee as, I guess, the most common exploit, right, for people who are using bridges or building bridges? Is there like one perfect model or one most optimized model that they should strive for?
If you're building a bridge, I mean, like, I think the easy answer is, I mean, you probably need at least 2 different audits. I think it's really difficult to understand what could go wrong. It depends on the complexity of the bridge, but whether you're using some external validator set, like an XLR, or if you're using more of like a off-chain like liquidity network like Connext, I think there's like a lot of things that could go wrong. So I think like audits is like the easy answer, but I think a lot of that just needs to come from also like hiring good people. I think people sometimes underestimate like the amount of like distributed systems and like cryptographic knowledge that you need to actually like build this stuff. And I feel like a lot of teams sometimes like cut corners just to get to market faster. And I think like that's where a lot of the issues start to come in.
It seems like the attention to detail for bridges should be, on par with, if not the same as, if not exceeding, layer 1 chains, because people's assets are involved, right? It's not like a game where, if it's hacked, okay, maybe some gamers get affected, but this is really the bedrock of the cross-chain economy. And I guess that kind of brings me to my next question, which some people have, which might sound a little bit extreme, but do we really need bridges given how insecure some of these bridges are? Like, why can't we just find one chain and then just build everything on that chain? Do you think the promise of a multi-chain future is threatened because of how tricky it is to actually get bridges right?
I think just like there are many design trade-offs with bridges, there are also too many design trade-offs with the underlying base layers. And I don't think you could have one chain that will do everything. I think like there was a lot of path dependency around how this current market evolved. I think there was, a lot of EVM block space demand, more so than in L1, than like ETH L1 could have serviced. And so you had a lot of teams that then just needed to move to other EVM chains even before a lot of the L2s were live. And so now you actually do have relatively like self-sustaining, thriving economies on these other chains that also have attracted their own developers, their own user bases. Some of this is geographic, but then you also had other base layers that came out, like Solana, that took like very aggressive design trade-offs, which I think is okay, because you do pop out like other use cases. And there's novel ways to even think about like how to construct blockchains from like the Celestia approach around like the modular blockchain thesis to Avalanche subnets to potentially application specific rollups on Ethereum. So I think there's just like way too much for any one ecosystem or one design to cover. So I think you need to find a way to connect these different systems, user preferences, and I think Bridges is an attempt at doing that. And again, there's still a lot of pretty deep like distributed systems problems and a lot of unknowns around like how to do it safely. And I don't think we are aware of some of the negative repercussions that could come down the line with these risks that we're introducing. But I also think we've gotten to the point where there's just too much consumer demand and investor demand and like business driven decisions from founders where we've just kind of gone to this like multi-chain world.
That makes a lot of sense. And I agree with your point that there's a lot of different risk factors. Just I was speaking to Pranay, the founder of Nomad, one of the bridges out there today. And I told him that I wonder if it's only people who are depositing into the bridge, depositing liquidity in the bridge, who should be worried about security. Like if you're just interacting with the bridge for like a few minutes just across your assets, you really maybe don't have much to worry about. And he told me that's actually wrong, because if you're using a lock and mint bridge, for instance, your asset like on another bridge could actually be worthless if the bridge gets hacked. So that kind of got me thinking, how should users decide which bridge to use, right? There's so many out there. I don't think, most people have the time or technical know-how to evaluate, like, is Synapse better than like any swap or hop or like Seller? So I guess for the everyday user out there, how do they think about what bridge they should use?
I think it's a good question. I mean, like the most basic thing is like, what does the user, like, where does the user want to go? I sometimes think about bridges as like you're trying to book a flight somewhere, or even like you're just trying to travel somewhere. Like, what's the best way to get there? Is it by plane, by car, by boat? I think there's like the most basic choice of like where you're trying to go. It's like a brand new EVM chain. Then that like Evmos or Moonbeam, then there won't be many options in the beginning. So I think like you just like constrain that design or like that decision to like the ones that exist. I think it's very unfortunate that a lot of the market associates TVL or asset issuance with safety, because we've seen, even in DeFi, just because a protocol has, a billion TVL, like that does not make it invincible. A compound is a good example. But in lieu of actually like doing research, that's probably like the biggest shortcut I could offer, because it does give like some notion of like safety or just being like battle tested. And then if you want to do like deeper research, I do think there are probably safer models out there. I'm personally not a big fan of external validator sets and like these federated networks. I think there's like the most trust that's being put in them. And
what are some examples of that?
I think like WormHole is doing like good work. I think like they have a very interesting product offering, which is connecting Solana, Terra, and Ethereum. And there aren't many bridges that could do EVM to non-EVM. A lot of the bridges are starting with just Ethereum and EVM because it's frankly less development work. They need to rewrite their code base in Rust and things like that. So I think like it's an important component that I think enables like a lot of value flow and innovation and things like that. But as it stands today, it is a trusted model in the validator set that's running those nodes. And I think what we've seen with Ronin is you could compromise, like it doesn't even have to be the individual node operators colluding. There could be some other way to compromise these nodes that leads to a very unhappy scenario. I think with Ronin, it was a 5 of 9 multi-sig effectively with their validators, but 4 out of the 5 were run by SkyMavis, the company, and they didn't discuss the details of how the hack happened, but you just need to compromise SkyMavis, and that gives you 4 out of the 5. And then for the 5th one, there was another issue there where they basically like SkyMavis gave permissions for this other one to like sign on their behalf, and so then you're able to get 5. And who knows if there was like someone like malicious within the company? I don't want to speculate, but you're still relying on like the small set of validators to manage a ton of capital that's only going to get bigger over the next few years. So the models that I tend to feel are safer are the ones where the security model is equal to that of the base layers that you're connecting. And I think like Connext is an example of a liquidity network that has that kind of like equivalent security. So these liquidity networks, Connext, Hop, Seller, are somewhat safer. And I think that light client bridges, assuming that there are no bugs, like theoretically are quite safe. I think like IBC actually is one of those as well. So yeah, Rainbow Bridge also, I think light client base bridge. Yeah.
And I guess just to put our investors' hats on for a second as well. One of the initial skepticisms I had about bridges as investments is that they're basically tunnels, and the way they accrue values, I suppose it's collecting a toll when you cross the tunnel. So every time someone uses a bridge, there might be some fees that's extracted. But the bull case is really only valid if you expect a lot of things to happen across chains. So even if, a lot of things happen on the Solana ecosystem, a lot of things happen in the Cosmos ecosystem, as long as there's not much activity between the tunnels, there's really not much value accrued to these bridges. I know some projects really disagree with me on this. For instance, like Layer Zero, their view is that there will be a lot of applications that straddle multiple chains at the same time. But I'm curious what your thoughts are on that.
I think tunnels is one way to frame it. I actually think the end state don't know if it's an end state, but I think bridges are more so developer platforms than they are tunnels. I do think that Nomad, XLR, Layer Zero have like these visions of being more of a developer platform. I sometimes think of it, I'm sure you've heard the analogy of like the app infrastructure cycle, where you ask like what came first? Is it the airplane or is it the landing strip? The answer is the airplane. You have a use case first, then you have infrastructure around it. Now we have multiple chains, and so you start to build a bunch of infrastructure to connect them, and then the next wave of applications builds on that prior infrastructure. And so I think in 1 to 2 years, we will have cross-chain native applications, and it's not just like copy pasting code on other EVMs. It will be applications that are building on the SDKs from these bridges that allows them to tap into all the different ecosystems that their users want to go to, and that's going to be totally abstracted on the user side. So I think it's going to be much more than just like a tunnel. And then the question is, well, like what are the comparables here? And it also depends on like the flavor of the bridge. Is this like a state machine? I tend like most like external validator sets, you could argue that like a comp could be like a state machine. Maybe if like the core asset is used as part of the security model and is required to transact on the network, you could have like some base layer comps there. I think to your point, if you do view it as a tunnel, then maybe a DEX is like the closest comp. If it's primarily used for asset transfer, and then you could start to do some math around like what are expected volumes and fees that come out of there. I think my view of it being more of a developer platform, maybe the comps there are around like Web3 infra. And there, that has the assumption that there's like some critical mass of devs building on it. So I think it depends on the bridge, and it depends on like what you think the vision of this infrastructure will be in 1 to 2 years.
Before I continue, I'd love to share more about our latest sponsor, CoinFlex. Now, CoinFlex is an exchange that's been around for a while. They're actually doing $1.5 billion in daily trading volume right now. Now, recently, their team reached out and walked me through their latest product, the AMM Plus. In short, it lets anybody earn fees as market makers on the CoinFlex exchange simply by depositing their assets. As of this recording, the 7-day in-range average for ETH AMM pool depositors is 82%. So how does this work? If you're familiar with how other AMMs out there work, this is very similar. You can basically select what price range to provide liquidity for, and the UI even shows you your risk under different scenarios. I also love that they have this cross-collateral system, so you can market make in any market you want, using pretty much any collateral you have. If you know how to manage your risks, you can even access up to 10x leverage while providing liquidity. So this is one of the most creative ways I've seen a company borrow elements from DeFi in a centralized exchange setting, so I highly encourage you to check it out at coinflex.com/AMM. I'd love to share one of my favorite products in crypto with you. Now, whenever I want to trade a token, instead of going to Uniswap, SushiSwap, Bancor one by one to see where I can find the best quote, I just go to Paraswap to scan for the best price anywhere. Because Paraswap aggregates all the popular Ethereum DEXes and saves me a ton of time and headache in finding where I can trade something for the best price, and lets me trade in one place. Now, the cool thing is they've also integrated with Ledger Live as well, meaning I can now swap at the best prices directly from my Ledger wallet. So seriously, if you're a DeFi trader and you're worried about the security risks of centralized exchanges, but you also don't want to scour dozens of DEXs just to find the best price, you have to check out Paraswap. So head on over to paraswap.io/blockcrunch.
That is really reassuring to hear more smart people disagree with me that the opportunity for bridges is a lot bigger than my initial assumption. And I think another interesting note to make here is the point about aggregators, because 1KX invested in an aggregator called Lee Finance or LeFi, which I'm an angel investor in as well. But I guess given the different security assumptions across all these bridges that we talked about and the vastly different constructions, can we actually, effectively aggregate bridges the way that we aggregate, say, like DEXes through 1inch or so on?
It's interesting because I was a huge fan of like aggregation theory. And I think like UniV theory has been a total like narrative violation, right? Because when you look at the market share of UniV3, it's something like 80%. And I think it's only been growing. And I was like pretty surprised at that. And every other EVM it launches on, it tends to just like eat that market share super quick. I think like UniV3 is like a really good product or platform. And I think the reason why it's done so well is because it had a ton of user behavior that just got like tied to it, and it had a lot of these like liquidity moats from like the assets that were being listed there, and this like nice flywheel between more users going there, which drives more protocol fees, which gets more liquidity providers to get on there, and it was really hard to match that because AMMs, like you could maybe have some variation on like the number of assets that could be in a pool. You could have the curve be different, the invariant. You could have the fees be different, but it's not a super wide design space. And I think like UniV3 is just like a good enough solution that that was able to capture most of the market share. I think with bridges, it's a much bigger design space there. And I also think like, yes, it will be a power law to some extent, especially on native asset bridges. Like Wrap Bitcoin, I think has like a ton of like a moat there. But I think there's still going to be way too many options for any one bridge to get it right. And I think even so, there is probably like 60, 80 bridge projects at this point. Even if we arrive at like a dozen after a few years, I think that's still a pretty strong business case for either a developer to integrate something like an aggregator like Lee instead of managing a dozen separate bridges and connections, and for a user to go to one front end and just says like, I want to transfer this asset to this place. I have this much to spend on gas. I have this amount of time to wait, and then have the algorithm do that for you. So I think like there are differences, I think, with like the design space of bridges that still make it much more worth it for an aggregator here versus like the AMM space in the last few years.
That makes a lot of sense. And I guess to kind of close out this part of the discussion about bridges, you mentioned there's 60 to 80 bridge projects. I didn't even know there were that many. I guess of all of these bridge projects, what would you say are maybe a few that you're personally most excited about or you're most bullish on?
Yeah, I mean, biased, I guess, because we are investors in Connext. I think it has like a really nice trade-off with what it does. You know, it transfers assets really well. It's a really safe construction, just really great team that's been building since 2017. I think Nomad also has a very interesting trade-off where it trades off latency for security. I think that design we haven't really seen a lot of bridges take advantage of, but I think you pop out again like other unique use cases for it, where if you're willing to wait 30 minutes, like for some transfer to go through, and if you're willing to potentially run some infrastructure to like make sure that's going to be a safe transfer, then who is that good for? You know, and maybe that's good for larger protocols that want to do like bulk transfers of treasury assets from like one EVM chain to another, and they'll run like that piece of infrastructure that makes sure that no one's messing around with that transaction. So I really like that that design trade-off and always like looking for bridges that just try to do something different effectively.
Yeah, I agree. I think when I'm moving significant amounts of capital, when I turn my ape mode off, when I think more about security, Connext and Nomad are the types of bridges that I'm excited about. That's why I'm also an investor in both of them. And I want to kind of take this time to pivot and talk a little bit about DAOs as well, because I think in this year alone, in 2022, 1KX has made several investments in DAOs or around DAOs. So things like Strider, Galleon DAO, or actual DAOs themselves, like Global Coin Research DAO. And you tweeted about DAOs a little bit while ago, and I think you mentioned that token networks are a business model innovation. So can you talk a little bit more about that and what gets you so excited about DAOs?
Yeah, I mean, I think we're excited about DAOs. I think that it's a very natural output of having this like open source software that's being built by people all around the world that could collectively shepherd the development of that software, and especially if there is much more native and fairly distributed value accrual mechanisms for the people that are contributing. So we've been a fan. We've invested in a lot of DAO tooling, like Snapshot and Tally, and we're actually like particularly excited about it from a early stage investing perspective. I actually think over like the next 2 years that DAOs will disintermediate early stage investing. There have been a lot of attempts at this from like AngelList in like 2010 to like the Jobs Act around more favorable like equity crowdfunding. And I think like with Ethereum, in 2015, you had more like crypto native like crowdfunding via token sales. And I think like we've effectively collapsed the like the capital aggregation cost to zero. And I think founders have like a lot more passive capital available. But I think all of these innovations haven't really addressed the thing that founders actually need, which is like services and operational support. And that could be around talent, design, BD. So I actually see like venture less as a financial services business and more of like a services business. Like a project receives funding and some value added services, and they pay for that in dilution. They sell percentage of token or equity. And I think the interesting thing is a lot of these DAOs that are forming around service DAOs, investment DAOs, incubation DAOs. I think they are actually unbundling these individual offerings of venture funds, and they provide far better unit economics for a founder. So founders effectively receive like more bang for their buck, like per unit of equity or tokens sold. So I think like that applies to things like service DAOs, which aggregate like some valuable service like design. And historically, you had maybe some individual freelancer who spends their time on one project. They also take a lot of risk on that one project, especially if they're receiving payment in tokens or in equity. But if they had a way to invest, I think that's a much better way to capture value and distribute risk, especially if there's a portfolio. And I think with crypto infrastructure, like service DAOs effectively enable this. And I expect, in a year or two for like half of a cap table of like a pre-seed round to be a variety of like these service DAOs that focus on design, talent, audit, things like that. So I think it's a different way to build a company that's like more of a fluid group of individuals and like assign ownership to those individuals. And I think it has like a lot of deep implications for different I guess like industries, and the one that's been most acute for us is actually how it is going to affect the investment landscape.
That is such an interesting point because obviously that affects what we do as VCs as well. So I guess how do you see VC stay relevant if most of the cap tables are going to be dominated by DAOs that unbundle us?
Yeah, I mean it's a good question. I think we've taken the approach of really embracing it. I think a lot of investors probably aren't set up to do this kind of work. Something that we've started to do is actually launch our own DAOs. We've experimented with one called Goblin Sacks. It's a DAO that's focused on NFT financialization. And the first thing that they're doing is, underwriting loans on NFTFi, which is a peer-to-peer platform for borrowing and lending NFTs. So this is not a service DAO. This is more of an example of you could consider it a demand side sub DAO for NFTFi that has its own community with a specific focus and its own way of sustaining itself. It's fairly profitable to underwrite these loans, and even if a loan defaults, we tend to sell that at a profit. Then when you think about other NFT financialization protocols that are fundraising, who do they want on their cap table? And if it's an early project that needs initial usage, well, like there's this DAO that literally does this. So I think like that's one way to do it. And I think it's difficult to have that like cultural shift for an organization, for a fund, to say, yeah, maybe we won't scale just by headcount, but we'll scale by other ways to draw in other pieces of the ecosystem. So I think like that's a style that I think we probably do that's particularly different from other folks.
That'll be pretty exciting. And we recently had an episode with Ian from Syndicate DAO, and they're creating these tooling for people to easily spin up investment clubs, which I think the definition of them is like any investment club, any entity with less than 99 investors and everyone's like actively participating, which is essentially an investment DAO. So with this tooling in place, I'm pretty sure that we're going to see a lot more of these things happening soon.
Yeah, I think it's also going to specialize. Like these DAOs, even if we take the investment DAO perspective right now, which if you look at maybe like 2017, like just crypto, right? Like we had ICOs and L1s, and then maybe in 2019 we had more DeFi, and then in 2020 we had more NFTs, and now we have like metaverse, like Web3, crypto social, gaming, and it's become so broad that I think it's super hard to just like cover one specific area. And I think a lot of these investment DAOs are going to be quite competitive by just like focusing on one niche, like Ready Player DAO, like just like, I don't know, like metaverse, like play to earn stuff. And I think like that that's going to be aggregating like very special talent. It's going to be getting like some pretty unique deal flow. It's going to be really hard for other folks to compete with that.
Yeah, and I really love this point about democratizing VC investing as well. I think VCs get a bad rep in crypto because they're seen as kind of insiders. They get access to opportunity, and I guess DAOs basically open this same opportunity set up to anyone who wants to put in the work and want to be a part of any of these DAOs. So that's one of the more exciting things, and I guess that's a great pivot to the final part, which is talking about some of your personal views as well. So I guess the first question I have for you is, what would you say is your highest conviction, or one of your highest conviction bets, or thesis in crypto right now?
Mm, I think we talked about a couple of them around like bridges as developer platforms and DAOs as disintermediating investing. I think another one um, that I sometimes have Twitter fights about is I think that social tokens have been doing it wrong and that they should actually be NFTs. I think a lot of the folks that have been working on social tokens are doing really great work, but I think we've had a lot of data that has shown why actually like NFTs are a better substrate for crypto social. And I think there's like two main issues with social tokens as ERC20s. Well, not fungible tokens. This could be on multiple chains. One is that you're trying to create a money. You're trying to create a medium of exchange. We've seen from 2017 how difficult that is to create some natural demand for like this money. And two, it is a one-to-many relationship between the token issuer and the buyers, where if you're buying I don't know, like the coin of some artist, like Drake coin. Like everyone is focused on the artist, but there's no real community that forms around it. And what NFTs give you, especially like these PFPs, is actually a many-to-many relationship. And I think like that's super, super important because you're able to actually create social connections that come from a place of belonging with all of the common owners, say like of this PFP collection. And if you do want to launch a fungible token, I think there's maybe a progression to that. But I think it for sure has to come after the NFT. And I think actually like Bored Apes was like a really good execution of that, where they started with the NFTs. They created a super fervent community, and then they were able to issue a fungible token that could be used in this like economy that they're likely going to build around it. Another analogy I could use is that NFTs are like passports to another country. And first you need enough people who want to like get the passport and then travel to the new country. And then when you're there, then you could think about issuing a money. So I think like that's the progression I would like to see. I think we are going to start seeing that. I think Bored Apes is basically, I would assume that they've caused some path dependency there, where now most PFP projects are going to look and say, oh, like we need a token, but not all of those are going to work because very few will have as strong of a community as the Bored Ape community. But I think, we'll see more of that happen.
Yeah, that's actually one thesis I agree with as well, just from my own experience trying to issue my own social token for the podcast. And then from what I've seen from artists issuing their own NFTs. We interviewed this guitarist from one of my favorite bands growing up recently called Avenged Sevenfold, and they released their own NFT for fans. And within a day of releasing that NFT, they also gave every holder 2 tickets to their next show. So as a floor sweeper, obviously I got like 16 or so tickets, but that's a type of engagement that was not found in social tokens for some reason. So I'm inclined to think that your thesis is probably how things is going to play out. I guess the final question I have for you is, given everything happening in crypto right now, what would you say one thing that, what would you say is like one thing that's most overhyped and one thing that's relatively underhyped that you would like more attention on?
Overhyped and underhyped. I mean, I think like there's an answer that kind of touches both. I mean, I do think that there's a lot of play to earn games, and you call them like play to earn Web3 games, NFT gaming. There's a lot out there, and I think like the funding landscape is like very easy for a lot of teams to be building stuff there. But I think that the way that a lot of them are approaching creating one of these games is pretty. It's very like Web 2, Web 2.5. It feels like they want to raise a lot of money and spend 2-3 years building this like really beautiful game. Just like amazing graphics, just like AAA quality. And I don't think like that's particularly special. I don't think it's better. Like, I don't think you're going to be able to compete with like traditional game publishers on that. I don't think that's what like crypto is good for. And I think there's been a lot of hype in like these really like beautiful like play to earn games. But I think what's like not paid attention to it, enough is actually like to what extent are these games creating community, and to what extent is their game incorporating economic aspects. So I think like instead of thinking about like play to earn games as just like standalone games, I think this is more about like building these like self-sustaining virtual nation state economies, and having people be a part of that. And for that, actually, I would argue that like you don't need an amazing game. You just need to have a good enough game that has enough of like economic depth, that takes advantage of the properties that like blockchains enable around like relatively real economic value, like native composability of assets. And I would like people to focus more on that part, like both like players, developers, investors, because I think that's where we'll see more like the special things pop out. And it feels like there's too much focus on like how can we create this like beautiful like 3D metaverse, I don't think that's going in the right direction.
That's super interesting, and I'm keen to see kind of what investments you guys make in that arena. And as always, it's been a really great pleasure to speak to you, Dmitry. For people who want to follow your writing, check out your blog, and just follow you in general, what are the best channels for them to do this?
Twitter, at Berenzon, DBERENZON.
At Berenzon. We will put that in the show notes below. Thank you so much again for taking the time.
Yeah, likewise. Thanks for having me, Jason. It was fun.